When business owners hear that we're going to talk about taxes, their first response is often, "This is such a boring topic." But today we're not going to go into theory or philosophy or anything to deal with the tax code. We're just going to talk about one thing. What do you need to know to save money on your taxes? What are the essential pieces you need? And that's it. You'll find we're going to fly through this. Income taxes. This is just government's way to tax you and generate revenue for the government when you have income. This is, when you talk about income, it's wealth from whatever source derived. With income tax, you as a business owner have one of the greatest abilities to minimize your taxes among all U.S. taxpayers. Business owners can control how much they pay in taxes because you pay tax on the profits, not the total income. So let me explain. Let's say you have $1 million in revenue, so total income, but you have $800,000 in expense. You only pay income tax on the $200,000 in profit. So what this means is by having a solid system of tracking expenses, that's one way you can make sure you are maximizing your expenses and thus minimizing your profit in order to minimize how much you have to pay in tax every year. So there are a couple tips here. First, make sure you have a good system to track all your expenses. Second, consider at the end of the year, somewhere around November, whether there are other expenses you want to add that will reduce your tax burden that year. I'll give you a typical example. Sometimes a business will pay the lease for their office space 1 month in advance, because as long as the business is a cash basis taxpayer, which most small businesses are, the business will be able to deduct in that present year when the payment is made the amount paid for rent the next year. So for example, let's say in November a business pays rent for December, January, and February. All of that will be deducted in the year when the payment was made, not when the payment was due. So that's a great way at the end of the year to reduce what you pay in taxes that year. Now sure, in effect you're bumping that forward until next year, so you may still have to pay that next year. But that's where having a good tax CPA can be helpful for you. So you look at your financial status and make some decisions at the end of the calendar year before the next year comes so that you can make some adjustments in your tax bill. You might say, I'm not sure if it's worth using a CPA. Especially small businesses sometimes try to do this on their own, or they will use an enrolled agent or H&R Block or something like that. I have found, and my clients have told me they have found, that it is always worth paying a little extra money for a CPA because of all the tax breaks and benefits a CPA finds. So in my experience, I have found that the CPA saves me more in taxes than the CPA costs to prepare the tax return every year and give a little tax advice throughout the year. So I recommend using a CPA, not another accountant who doesn't have the CPA credentials. Anybody can call themselves an accountant or a bookkeeper in most states. Anybody can register with the IRS to become an enrolled agent. But to become a CPA, you have to demonstrate a fairly high level of proficiency with tax laws and accounting in order to get that certification. And in my experience, that is money well paid. Let's talk about sales and use tax. We all know about sales tax because when we go to check out at a restaurant or some other convenience store, we see the sales tax being charged. But what is use tax? Most business owners don't even know what use tax is unless they're required to collect it. When a person buys something that's subject to sales tax in Minnesota, the company must collect that sales tax and then turn it over to the government. And that's the state tax collection agency. We don't have a U.S. sales tax. We don't have a federal sales tax, in other words. It's only state by state. Some states rely more on sales tax. Some states rely more on income tax or property tax. But here's the key to know. First, are you required to collect sales tax? That's step one. Step two is, are you required to collect sales tax for people who are buying from other states? This is a very challenging area because a lot of e-commerce companies who are selling to other states have found out the hard way that they may be required to collect sales tax for states they're not located in. Without getting too deep into this, the short answer is it is risky not to collect sales tax. And if you are regularly selling to other states, the best practice is to use some sort of nationwide software that can figure out how much are you supposed to collect in every state and county and city. It's gotten really confusing because if somebody buys from a little city in a little county in some state, how are you supposed to know as the seller how much tax to collect and then turn into the government? It's very difficult to track because every city and county in most states can have their own little taxes on this stuff. So the best practice is use some sort of e-commerce software or some nationwide software that can help you figure out how much do you need to collect. And most of the major e-commerce software can do this. There's other software that can help you do it if you're selling a service nationwide and you need to figure out if that service is taxable. States can decide for themselves what is subject to sales tax, and if you don't collect it, you might still owe it. This can be very surprising to some companies. I had one client come to me, and she had been running a business for many years, didn't realize that during that time, the legislature in our state had changed the law and had started charging sales tax on her particular area of business. Because she hadn't collected it for many, many years and had not reported it, the government said she owed all of those back taxes. But here's the problem. It was a sales tax. It's not normally paid by her, it's paid by her customers. But she didn't even know she was supposed to collect it. The government didn't care. The government said, you still owe that money. She had no practical way to go back and collect it from all of those customers over the years. So at the end of the day, she had to somehow come up with paying the money. Long story short, we negotiated a compromise with the government, but that's a situation you don't want to be in. So make sure you identify for your area of business, do you need to collect sales tax? Now you might say, well, what is use tax? Let's say, for example, that you buy a product in your state that would normally be subject to sales tax. But then instead of buying it in your state, you decide to go and you find a website in another state and they don't collect sales tax. Well, the law says when you bring that product into your state and you use it here, you need to turn over what would normally be called sales tax if purchased in your state. You need to turn over that amount in use tax. Now, this is a state-by-state issue, but the general idea is sales and use tax goes hand in hand. And if the state can't collect the money from you On the sales tax side, because you bought from someone outside of your state, you are still required to pay use tax. This was a big deal when Amazon was selling to people in all 50 states and wasn't collecting sales tax. The state governments started going after businesses saying, hey, you've been buying from Amazon. You didn't pay sales tax on those purchases, but you're using the products here in Minnesota, so you have to turn over use tax. Basically, states realized we can make a lot of money. It costs us less to hire some tax agents to go after these businesses because we'll get so much more money from the businesses that pay these tax bills. So you don't even want to deal with these audits. At the end of the year, typically you need to pay a use tax. That's if your state has that. You can work with your CPA on this, but generally speaking, it's just the sales tax amount for any products that would be subject to sales tax, but you didn't pay sales tax because you bought them from out of state. Now, if you don't buy stuff from out of state, you typically don't have to deal with this. There are a ton of exceptions. There are many different rules related to this, but that's where a good CPA can help you figure out what do you need to do to make sure you avoid violating the law in your state and running into an audit. Payroll tax. Many of you know what payroll tax is, but just so we're all on the same page, I'll give a brief explanation. Remember when you had your first job and you were expecting a certain paycheck, and then you saw all these withholdings, that goes out to the government for this and for that and for that, and all of a sudden your paycheck was a lot less? That is essentially the payroll tax. Half the payroll tax is paid by the employee, and roughly half the payroll tax is paid by the employer. Generally, it's about 15% total, so about 7.5% for the employee, 7.5% for the employer. So as an employer, you obviously are having to collect all of this, because if you're taking it from the employee's paychecks and withholding it, now you're holding on to that money, and you need to turn that in on a regular basis to the government. You also have to turn in your portion on a regular basis to the government. Usually a CPA will help you with that, or a payroll service like Paychex or ADP. Generally speaking, a CPA costs about the same as Paychex or ADP, and some companies prefer one approach over the other. I use a CPA for everything, just so everything's in one place, but some places find that it's just simpler for their system to have the software provided by like ADP or Paychex. So why are we talking about this? How can you possibly save money on this? The big opportunity is if you are not an S Corp, you might be able to save some money on it going to be an S Corp. To do that, you typically just file a form with the IRS by March 15th of the calendar year in which you want it to apply. So if you want to benefit from being taxed as an S Corp in 2025, you have until March 15th of 2025 to file that form. You can do that if you're an LLC. You can also do that if you're a corporation. Now there's some rules around this, and it's best to work with a CPA on doing that. A CPA can also help you figure out how much money might you save being an S Corp. As a rule of thumb, business owners have often found that after they pay all of their expenses and they have about $50,000 left at the end of the year in profit, if they have more than $50,000, an S Corp makes sense. If they have less than $50,000, an S Corp may not make sense, and it's just simpler to be an LLC under the default rules, not under an S election. So if you're an LLC, you might be wondering, do I have to actually change to become a corporation in order to get taxed as an S corporation? No, you don't. An LLC can simply file a form to be taxed as an S corporation, but the LLC remains an LLC. Now, you can't have the benefits of an LLC and the benefits of an S corporation, So as an LLC, you essentially need to follow the same rules that an S corporation would follow. One of the big rules there is that you can't have multiple classes of stock. You can't have like A stock and a B stock. But for most small businesses, that's not an issue. All right, so to recap here, having a good CPA who you connect with a couple times a year can be really helpful. First, you want to make sure you're tracking all expenses, and at the end of the year, before the year ends, talk with the CPA and make some decisions about any other ways you can reduce your taxes by increasing your expenses. Now, by the way, I'm not suggesting that you go blow your money on something frivolous, but rather you prepay something that you'd already have to pay in January or February. Second, you want to make sure that for sales and use tax, you're collecting whatever you need to so you can stay compliant with the law. You don't want to get an audit and find out you have some surprise tax bill. And then finally, consider with your CPA whether being taxed as an S Corp might save you some money. There's one other benefit in working with a CPA. If you rely on the advice of a CPA or an attorney, because both of them are licensed professionals, licensed to give you advice on taxes, if that professional ends up being wrong and you end up owing money, it is a defense to tax fraud to say, I relied on the advice of a professional. I relied on the advice of a licensed CPA or attorney. This doesn't work for a non-licensed accountant or bookkeeper or enrolled agent. This is really important because sometimes you may decide I'm going to be aggressive in the tax deductions I'm going to take or the exemptions or how I structure my taxes. And you might do so in coordination with your CPA or tax attorney. And if you did so in reliance on their advice, then even though the IRS may disagree with it later, and you might have some sort of penalties and owe some interest, you will have a strong defense to a criminal charge of tax fraud if you say, hey, but I relied on the advice of a professional. So that is one compelling reason why many business owners find it is worth having a CPA work with them over the years. We've talked a lot about risks. Now, instead of preventing the risks, we're going to talk a little bit about insurance and how you can mitigate some of those risks by having some insurance policies in place. The purpose here is just to give you a quick preview of what's available so you can work with a business insurance agent who can help you figure out what exact policies would be appropriate for you, and you can weigh the costs of those. Unemployment insurance. In some states, this is handled by private insurance companies. In other states, it's handled by the government. And the bottom line is that employers often are required to pay unemployment insurance or pay towards it, because if a person then is terminated by the employer, so they get fired or let go, that employee can collect unemployment. Employers pay into that fund, and then employers have their annual or monthly rates set for that fund based on how many of their employees, or ex-employees we could say, are using it. A lot of times employees who collect unemployment think that the government is just giving them free money. That money is coming from the company, from the employer, and it may not be dollar for dollar, but basically whatever the ex-employees use in the unemployment system, the company gets charged for. So making sure that you are compliant with your state's unemployment insurance laws is important, and a CPA can help you with that. Workers' compensation insurance is simply an insurance policy that says if a person gets hurt on the job, they will have some sort of coverage for that injury. Many states require employers to carry workers' compensation insurance, and usually it isn't that expensive for jobs like office jobs. And so checking to see if your state requires worker compensation insurance paid by you as the employer is an important step to make sure you don't run into violations of your state workers' comp laws. Key person life insurance is a policy that is often purchased by business owners. Here's where it comes into play. Imagine you have two business owners, and one of them passes away unexpectedly. If you have key person life insurance on both of them, then when one passes, the other gets a payout. And usually that payout is set to be the same amount as the value of their shares. So let's say two owners, 50-50 owners. One of them passes away, and let's say a $500,000 policy goes to the other owner. That policy pays out cash to the other owner, who will then buy out the spouse of the deceased owner. So, for example, all the shares would now be owned by the living owner, and the money for those shares would get paid to the living spouse of the deceased owner. So effectively, the surviving spouse ends up with the cash from the insurance policy, and the surviving business owner ends up with 100% ownership of the company to continue running the company. That's how key person insurance is often used in jointly owned companies. It also might be used just for spouses. So for example, if one person owns the company and they pass away and they're not going to be able to generate income anymore, the other spouse might have a policy payout so that he or she is getting some sort of compensation from this loss because they will no longer be able to rely on the business generating money for that person. So key person life insurance is basically just life insurance for a key person. It's not always collected by a spouse. It might be collected by the other business owner. General practice liability is basically your most generic insurance policy for a business. This is the kind of insurance policy that would typically say, hey, if somebody gets hurt inside our business and a customer is here and they get injured due to our negligence, the insurance company will pay for that person's medical bills. General practice liability, or GPL, is just your basic insurance coverage for a business, but it often doesn't include a lot of the areas that are most important to businesses, and we'll talk about those coming up next. One of the ways businesses can get sued is for mishandling or allegedly mishandling employee situations. Many times ex-employees sue the company for being discriminated against, wrongfully terminated, or being treated unfairly. Sometimes employees will sue for retaliation. Maybe they reported some sort of wrongdoing as a whistleblower, and then they got disciplined or discharged for that. When those employee lawsuits come in, there's a particular type of insurance policy that can cover the company for that. It's called Employment Practices Liability Coverage, or EPL, sometimes called EPLI, Employment Practices Liability Insurance. Basically, the idea is, look, once you start getting a number of employees, the odds of getting sued goes up, and many times companies with over 10 employees start to find that it would make sense to have some sort of insurance policy if they get sued or have some sort of legal action associated with former employees. It only takes one legal action, so like one lawsuit or one EEOC investigation, for you to spend more money on an employment attorney than you would on a one-year policy that would protect you from all claims of that type. So typically I recommend when you get to have over 10 employees, it makes sense to get an employment practices liability insurance policy. It's usually not very expensive, especially if you've never had claims and you have a clean record, and it can provide extraordinary peace of mind. Look at it this way. It's a lot easier to pay a few $1,000s a year to an insurance policy than get hit with a $50,000 or $100,000 legal bill in a particular year when you have some sort of legal action involving a disgruntled employee or somebody who falsely claims you did something wrong and you have to defend it. So this is not just for employers who are planning to be racist or planning to do something wrong. No, the best employers still get these sorts of claims. Why? Because statistically, you will run into some very difficult people, whether you want to call them. I mean, statistically, there is a portion of the population who is psychotic or who is a narcissist or who has other problems. And when you are hiring enough people, you will run into statistically these people, and so you want to be prepared. One of the easiest ways to prepare for that is just pay out a small amount each year for an employment practices liability policy. And again, I'd recommend it if you have over 10 employees. There are other sorts of errors that companies can make, and there are insurance policies designed for those errors. For example, you might get an errors and omissions insurance policy, or it might be called a professional liability insurance policy, or maybe directors and officers insurance policy. The whole idea here is for any sorts of errors that occur, your industry may have a policy that will cover those sorts of errors. And so I'd recommend talking with a business broker about those errors. With a lot of these policies, it's just going to be weighing the pros and cons. For example, you might think to yourself, what are the odds that we would get sued for the type of claim or injury that's covered by this particular insurance policy? So you might say, well, maybe it's 1 in 20, just hypothetically, picking a random number. All right, well, how much would it cost us then to deal with that sort of claim? Well, let's say it's $80,000 in legal fees. Okay, so would we rather pay out the monthly amount or the annual amount for this insurance policy, or play the odds, let's say 1 in 20, that each year that goes by, we might have to come up with $80,000? So it's just simply thinking through statistically what that looks like. That's what the insurance companies have done as well. And they've essentially spread that risk around with a little profit margin for themselves so that you're paying in a little bit each year with the understanding that you or somebody else in your same situation, they call it risk pool, would have a payout event. Generally speaking, you have a pretty good idea as a business owner in your company, the types of risks that you're going to run into, the types of things you might get sued for. And so it makes a lot of sense to think about those risks and identify, is there an insurance policy that can cover you for those risks? By the way, this raises a really important point. Always be honest in your applications, because I've seen many times where people are not quite honest in their insurance application because they want to get the best deal, or they want to get coverage where they're not sure they would get coverage if they were fully honest. What you may not know is that once you have a claim, the insurance company will look back at the application you filled out to see if it was honest in every aspect. And the insurance company has the option of returning what you have paid if you've been dishonest, rather than paying out on the insurance claim. So you're not getting ahead by being dishonest in any way, even if it's a small way in an application for insurance, because the insurance company will take your money. You might think, well, wait, they took my money. They accepted my application. No, they have an opportunity up until the point of paying out on a claim to reject your application for dishonesty and just give you back all the money you've paid to date rather than paying out on that claim. So you always want to be brutally honest on the policy application. When you apply for insurance, be brutally honest, because the last thing you want is relying on a payout and then find out something was not quite right on your application, and now the insurance company is using that to deny your payout. Cybersecurity or data breach insurance can be important if you are collecting a lot of medical or legal or accounting or other data about customers. If you want to have a policy in place in case you are ever hacked, you can get for fairly inexpensive that sort of policy. Let's talk about employee health plans. Sometimes companies will offer an employee health plan. Many times this is done for two primary reasons. First, it can reduce how much is paid in taxes because the company is now covering significant expenses associated with employee health plans. And that includes for the business owner herself. Second, it can help you get top talent. It can help you be competitive with all the other big corporations out there that are offering employee health plans in order to be competitive. If you're thinking about doing an employee health plan and providing employee health insurance to your team, I'd recommend working with a CPA who's knowledgeable in this area to figure out what would the actual benefit be for you on a tax basis. Generally speaking, there's a small tax benefit, but a substantial cost, because the tax benefit you get is essentially from increasing your expenses for all of your employees. Employee disability plans. If an employee is disabled due to something that happens on the job, they're allowed to collect workers' comp. But if they're disabled for a long period of time, workers' comp will eventually end, and you can get additional plans that provide coverage for disabled employees. These are usually very inexpensive. They also are rarely utilized. In my experience, employers get these disability plans because they cost so little, and it's a little thing that they can tell their prospective employees who they're trying to attract to their company in the hiring process. Hey, we also offer a disability insurance policy of $50,000 or whatever that amount may be. It sounds like a lot to the employees, but again, the reason they're so cheap is because employees so rarely get disabled that it is very rare for the insurance company to pay that money out to the employees. And then finally, there might be some risk in your company that's specific to your industry. And so the best practice is just do a little checking with either AI or Google, or talk to a business insurance broker or all the above, and figure out, are there other risks that you're facing that you might be able to get insurance to cover? Now, there's certain sorts of activity that you'll never be able to cover. For example, if you don't pay your taxes, there's no insurance company that's going to come in and say, oh yeah, we'll pay your taxes for you. Or if you assault somebody, or your employees assault somebody, in other words, they hit them or they batter them, it would be extremely rare for any insurance policy to cover something like that, because that's an intentional act. But insurance companies will often cover negligence. So in other words, hey, we made a mistake. That's the kind of thing that you can often get insurance for. And the whole idea is, hey, if you can pay out a little bit every month or every year so that you don't have these big events that can just crush the company, that may be worthwhile to you. So to recap, there are two ways to save money on legal fees. One is doing things right in advance. And then second, even though you might do things as carefully as you can, maybe you can get some insurance to mitigate those risks. So if you do have some sort of legal event, the insurance company pays it out.